Right now, your money is sitting in a bank account. And while it sits there, the bank is lending it out at 15 to 20% interest and paying you back 0.5%. That gap, that massive gap between what they earn on your money and what they pay you, is the engine of one of the most profitable businesses ever built. And it runs entirely on your ignorance. Today, that ends. Banks are not your friends. They are not your enemies either. They are businesses. Extraordinarily well-designed businesses, built to extract maximum value from every interaction they have with you. And the first step to using the banking system rather than being used by it is understanding exactly how it works. Here is what we cover today. How banks actually create money. The answer will shock you. The 5 ways banks profit from ordinary customers every single day. How to stop being the product and start being the player. The banking tools that genuinely serve you and how to find them. What credit scores really are and how to use yours as a weapon. How the wealthy use banks completely differently from everyone else. Stay until Chapter 6. That chapter rewires how you see every bank interaction for the rest of your life. Before we begin, drop a comment. One word. How do you feel about your bank right now? Trust? Suspicion? Confusion? Every answer shapes what I create next. 3 seconds. Let us begin. Here is the thing that almost nobody in the world understands, including most people who work at banks. Banks do not lend out the money you deposit. Not directly. When a bank gives you a loan, it creates new money. Digitally, out of nothing. It types a number into your account. That number did not exist before. Now it does. This is called fractional reserve banking, and it is the foundation of how the entire modern financial system operates. Here is how it works. The central bank in Tanzania, the Bank of Tanzania, sets a reserve requirement. Banks must keep a percentage of deposits in reserve. The rest they can lend out. But here is the twist. When that loan gets deposited somewhere else, that bank can lend out most of it again. The same original money spawns loan after loan after loan. 100 shillings of deposits can generate hundreds of shillings in loans across the system. Money multiplies. Through debt. Why does this matter to you? Because every loan you take creates profit for the bank, from money that did not exist before the loan. And every deposit you make gives the bank raw material to create more loans and more profit. You are not just a customer. You are the raw material, the fuel. Understanding this changes how you see every financial product a bank ever offers you. Let me walk you through exactly how the bank extracts value from your financial life. Not in theory, specifically. Mechanism 1, the interest rate spread. You deposit money. They pay you 0.5%. They lend it at 15%. That difference, 14.5%, is pure profit on your money. The larger your deposits and the larger their loan book, the larger this spread. This is the core engine. Everything else is secondary. Mechanism 2, fees, account maintenance fees, ATM withdrawal fees, transfer fees, below minimum balance fees, loan processing fees, card replacement fees, dormancy fees. Banks have engineered a fee structure around almost every action you take. The average bank customer pays thousands of shillings per year in fees without ever adding it up. The bank counts on you not counting. Mechanism 3, late payment penalties. When you miss a loan repayment, the bank does not just charge you the missed amount, it charges a penalty. Plus compound interest on the overdue balance. Plus sometimes a restructuring fee. A missed payment does not just cost you the missed amount. It can cost you 2 or 3 times that amount by the time all charges are applied. Banks profit most from the people who are struggling most. By design. Mechanism 4, cross-selling. Your bank is not just a place to keep money. It is a sales organization. Every time you visit, physically or digitally, the bank is looking to sell you a product, insurance, a credit card, a personal loan, an investment product, a mortgage. These products are not designed primarily to benefit you. They are designed primarily to generate the bank's revenue. Some are useful, many are not. Knowing which is your responsibility. Mechanism 5. Data. Your transaction history tells a bank more about your life than almost anyone else knows. When you earn, what you spend on, how you behave under financial stress. Banks use this data to decide who to lend to and at what rate. They use it to time product offers. They sell aggregate versions of it to partners. You are not just a customer. You are a data source. Your financial behavior is valuable information, and the bank owns it. Now, how do you flip this? How do you go from being the raw material the bank profits from to being someone who uses the bank's infrastructure for your own benefit? The first step is eliminating unnecessary costs. Every fee you pay the bank is a wealth transfer from you to them. Go through your bank statement this week. List every fee. Then ask, is there a product, a bank, or a behavior that eliminates this fee? Most fees are avoidable. Digital banks and mobile money platforms have fundamentally changed the fee landscape in East Africa. Platforms built on mobile infrastructure often have lower fees, or none, compared to traditional banks. In Tanzania, Tigo, Pesa, M-Pesa, Airtel Money, and newer fintech offerings often allow you to store, send, and receive money at a fraction of traditional banking costs. The traditional bank does not advertise this. The alternative provider does not reach you through the same channels. Finding it is your job. Use the bank for what it is good at: mortgages, business loans, secure large value storage, foreign exchange, international transfers. These are areas where banks have genuine infrastructure and regulatory protection that alternatives cannot fully replicate. Use mobile money for everyday transactions. Use the bank for structured borrowing and large asset finance. Separate the use cases. Pay for only what you actually need. Negotiate your rates. Most people accept the bank's first offer as fixed. It is not. If you have a good deposit history, a clean repayment record, or a significant business relationship, you have leverage. Call your relationship manager. Ask for a better loan rate. Ask for fee waivers. Ask what the bank can do for you in return for maintaining or growing your business with them. Banks negotiate, especially with customers who understand that they have a choice. In Tanzania and across East Africa, credit reference systems are still developing, but they are developing fast. The Credit Reference Bureau, CRB, now holds data on borrowing behavior across the formal financial system. Banks, microfinance institutions, and increasingly mobile lenders report to it. And a positive credit profile, a record of consistent, responsible borrowing and repayment, is becoming one of the most valuable financial assets you can build. A strong credit profile does three things. 1. It lowers your borrowing cost. Banks and lenders charge higher rates to higher-risk borrowers. The lower your risk profile, the lower your rate. 2. It increases your access to larger loans. A property mortgage, a business expansion loan. Finance that is unavailable to someone with no credit history. 3. It gives you negotiating power. A borrower with a clean record has options. Options are leverage. How do you build a strong credit profile deliberately? Take small loans even when you do not need them. Repay them perfectly, on time, every time. A small mobile loan repaid consistently builds a positive repayment history. Then graduate to larger instruments. A small bank loan. A credit card used carefully and cleared monthly. A business overdraft maintained within limits. Each successful repayment is a brick in your credit profile. Build it before you need it. Credit card discipline. If you have a credit card or plan to get one, here is the only rule that matters. Pay the full balance every month without exception. A credit card used this way gives you a free short-term loan, purchase protection, and credit history at zero cost. A credit card with a revolving balance gives the bank 20 to 30% annual interest while giving you the illusion of purchasing power you have not earned. One usage pattern builds wealth. The other destroys it. The wealthy do not trust banks with their wealth. They use banks as infrastructure. There is a critical difference. They keep only what they need in liquid bank accounts. The rest, they deploy into assets, investments, property, business, things that grow faster than bank interest and are not subject to the bank's fee structure. The bank is a utility, like water or electricity. You use it. You do not live inside it. The wealthy use debt as a tool, not a crutch. When they borrow to acquire assets that produce more income than the debt costs. A business loan at 12% to fund a business generating 30% returns is a wealth-building tool. A personal loan at 18% to fund a holiday is a wealth-destroying crutch. Same bank, same product. Completely different outcome based on what the money is used for. The wealthy maintain multiple banking relationships, not out of complexity, out of optionality. A relationship with a commercial bank, a microfinance institution for specific purposes, a mobile money platform for transactions, an investment account separate from their operational bank. Each relationship serves a specific function. No single institution has all their money or all their leverage. Concentration is risk. Distribution is strategy. The wealthy read the fine print. Every banking product has terms, fees buried in schedules, rate change clauses, early repayment penalties, lien provisions that give the bank rights over your assets. Most people sign without reading. The wealthy, or their advisors, read everything. A 30-minute investment in understanding a loan agreement can save years of unexpected costs. Never sign a banking document you have not fully understood. Before we close this chapter, the real gem hasn't even dropped yet. What comes next could completely change the way you see money, side hustles, and building wealth. In the next video, we're going deeper, smarter, and more practical. I'll show you the exact moves most people ignore until it's too late. So don't disappear into the internet jungle. Make sure you watch part 2 right after this, because that's where the puzzle finally connects. See you in the next video.